Welcome back to the deep dive. Well, if you've had an eye on the Bitcoin charts over the last, say, 24 hours, you know exactly why we're here today.
Oh, yeah.
We are looking at what you could really only call a violent structural shift in the market.
Definitely violent.
On one hand, you've got this painful, almost classic derivatives-driven technical breakdown. Painful stuff.
Textbook. Okay.
But then on the other side, the long-term picture, the fundamentals, the institutional plumbing being built, and the core tech, it's all accelerating faster, actually, than we've ever tracked before.
It really is picking up pace.
So our mission today really is to cut through all that noise. We need to guide you, our listener, through the short-term chaos, try to separate the fear, the derivatives fear from the real adoption signals, and figure out, well, what's the true state of this market right now? Okay, let's unpack this. It's a real conflict.
It absolutely is. An acute tension, you could say. And we have to stress the price action was dramatic, no question.
Yeah.
It was pure fast money de-risking. Just getting out, forcing a really sharp repricing downwards.
Right.
So we're watching this clash between that fast money reacting instantly to fear, to volatility, versus what you might call strategic capital.
The big players.
Exactly. The big players quietly laying down the tracks for the next, decade of finance. They're making these huge long-term bets. And, well, those bets don't always line up with the day-to-day swings.
Not at all. Okay, let's start with the immediate pain then. Part one. The short-term reckoning, price and technical breakdown.
Let's do it.
What was the root cause here? Well, we were looking at a massive deleveraging event happening right before that huge September 26th options expiry.
Historically large, yeah.
Yeah, the notional value on that was approaching, what, $23 billion? Yeah. Huge number.
$23 billion. Massive.
And the selling pressure just became relentless. It kicked off a cascade, liquidations just triggering more liquidations.
The usual cascade effect.
Yeah, exactly. End up wiping out nearly $1 billion in leveraged long positions, market-wide, just gone.
Poof, $1 billion.
And that drove the price down hard to a 4-week low, landing us right around $108,713.
And that market structure failure, it didn't happen in a vacuum, right?
No.
It was definitely amplified by these growing external worries, mostly fears, swirling around a potential U.S. government shutdown.
Ah, yes. The shutdown talk.
Yeah, polymarket traders, they're actually pricing in like a 76% chance of a shutdown by the end of the year.
76%, wow.
Yeah, and that kind of macro uncertainty always casts a chill, over risk assets like crypto.
Always does.
So looking at the charts now, the technical picture has really shifted, fundamentally. That old support range, around $111,000 to $112,000.
Yeah, that held for a bit.
It's broken, definitely broken. And that zone has flipped now. It's our first major resistance level overhead.
Right, so the floor became the ceiling.
Pretty much. So the immediate fight, the battleground, is defending that session low support around $108,700. If that fails, well, then you're looking at tests potentially near $107,500, maybe even that big psychological line at $100,000.
Oof. The $100 K mark. Okay. And with all this fear sloshing around, the fear and greed index, unsurprisingly, dropped sharply. Down to 32, right, deep in fear territory.
Deep in fear, yeah. Reflects the mood perfectly.
But here's where it gets interesting, I think. We need to pivot slightly to something deeper. Data that actually supports this cautious mood, but it's coming from the really sophisticated players, the long-term holders, or LTHs.
The diamond hands, supposedly?
Right. Well, Glassnode analysis is pointing towards growing market exhaustion. That's a condition they see often correlated with market cycle tops.
Okay, exhaustion.
Specifically, these LTHs, they've taken a pretty staggering 3.4 million BTC in realized profit this cycle. Now, 3.4 million BTC sounds enormous, but how significant is that distribution really when you look back historically?
Yeah, it's a huge number, and context is everything.
Yeah.
So 3.4 million BTC. To put that into perspective, that's roughly 17%.
17%. Wow.
17% of the total circulating supply being sold by the groups who, theoretically held it all through the bear market.
Right, the ones who bought low.
Exactly. And when you look back at past cycles, distributions of that size, that velocity, it signals that the quote-unquote smart money is offloading a significant chunk of capital. They're essentially passing the baton, to newer investors.
Handing it off.
Yeah. This kind of sophisticated distribution puts serious pressure on demand institutional retail to absorb all that supply without the price just cratering further.
So it's not just the leverage squeeze.
No, absolutely not. It tells us there's calculated significant profit-taking happening underneath the surface volatility.
Okay, that makes sense. Which brings us perfectly to part 2, the institutional paradox. Flows versus future products.
Paradox, yeah.
Because the immediate institutional reaction to this volatility, it looked like they ran for the door. U.S. spot Bitcoin ETFs saw a net outflow of $253.4 million on Thursday.
Big outflow.
Yeah.
Reversed the day before.
Totally reversed Wednesday's strong inflows.
Yeah.
So if BlackRock and these other strategic players are so bullish long term, why are we seeing, $250 million just flee like that? Isn't that proof that institutional interest is still pretty fragile, still skittish?
That is the perfect question.
Yeah.
And the answer lies in understanding who is leaving. That $253 million, that's likely tactical capital.
Okay. Hedge funds, traders?
Exactly. Hedge funds, maybe faster-moving family offices, traders. They're fleeing the volatility. That's their job, manage short-term risk. But their flight is precisely why we have to look beyond the flows and see what the strategic players are actually building.
Right, the infrastructure.
The infrastructure.
Yeah.
Look at the latest BlackRock filing. They just filed for something called the Bitcoin Premium Income ETF.
Premium income.
Now basically being described as a sequel to IBIT, their main spot ETF.
A sequel. Interesting. What's different?
The difference is huge. Unlike IBIT, which is pure spot exposure, aiming for capital appreciation. Yeah. This Premium Income ETF is designed explicitly to generate yield.
Yield. Okay.
Almost certainly using a covered call strategy, or maybe a buy right strategy, selling options against the underlying Bitcoin to generate income.
Got it. Covered calls.
And the significance here, you really can't overstate it. This targets an entirely different, much more conservative slice of the market. Think income funds, maybe retirees, endowments.
Institutions with mandates for income, not just growth.
Precisely. Accounts whose mandate requires predictable income streams, not just, volatile spot exposure. They likely wouldn't touch a standard spot ETF with its ups and downs.
So the divergence is key here.
It's stark, isn't it? Short-term money is selling the dip, running from the volatility. But the world's largest asset manager is spending serious time, money, resources designing a yield product for clients who need stability.
They're building for a different future demand.
Exactly. They're building complex infrastructure based on anticipating this massive, future, more conservative demand. They're effectively building a buffer against the kind of volatility we just saw.
Fascinating. Okay, let's move beyond ETFs then. Part 3, corporate treasury. You mentioned it's hitting an inflection point, becoming more professional.
It really is.
But first, we have to address the regulatory side, the scrutiny. We saw reports the SEC and FINRA launched an inquiry looking into abnormally high trading volumes and sharp stock price increases that happened before some companies announced they were putting Bitcoin on their balance sheets.
Yeah, the regulators are sniffing around.
They seem focused on potential violations of Regulation Fair Disclosure, or Reg FD.
Yeah.
And trying to crack down on the so-called MicroStrategy effect, maybe companies hyping their stock opportunistically.
Right.
For listeners, what exactly is Reg FD, and why are regulators suddenly zeroing in on this now with Bitcoin treasuries?
Okay, Reg FD is actually a really critical rule. It's designed to prevent selective disclosure. Basically, it means if a public company is going to announce something material, something market-moving.
Like buying a huge stack of Bitcoin.
Exactly. Like buying Bitcoin for treasury. They have to disclose that information broadly to all investors at the same time, not just whisper it to a few friendly hedge funds beforehand.
So no inside track.
Precisely. Regulators want to crack down on any company that might be, let's say, signaling its Bitcoin buying intentions in a way that allows insiders or preferred investors to profit before the official news hits the wires.
Makes sense. It's a sign of maturation, right?
It absolutely is. It shows corporate Bitcoin adoption is moving out of that initial kind of Wild West phase and into a much more serious regulated environment.
Okay. But you said there's a beautiful counterpoint here, the forward-looking infrastructure being built.
Yes. While regulators look backward, the industry is building forward. The whole corporate treasury thesis is rapidly professionalizing. We're seeing concrete examples.
Like what?
Well, for instance, firms like Public Square and IDX Advisors just launched a Treasury as a Service platform. TAS. Treasury as a Service. Sounds like a complex finance buzzword. What does that actually mean for, say, a small or medium-sized business? Yeah, it sounds jargony, but it's actually about simplifying things. It's professionalizing the whole process. These Tardanias platforms basically offer businesses a compliant one-stop shop for integrating digital assets into their treasury.
So they handle the tricky parts.
Right. Things like enterprise-grade custody, secure trading execution, maybe even yield services on the digital assets. It takes the guesswork and a lot of the risk out of it for companies dipping their toes in.
Okay, that makes corporate adoption much easier.
Way easier. And alongside that, you see firms like Vols Capital. They just appointed BitGo as their institutional-grade custodian for their Bitcoin treasury.
BitGo, a big name in custody.
A very big name. And that move is all about prioritizing top-tier security, compliance, aligning perfectly with traditional finance best practices.
Right.
This whole trend, this professionalization, it clearly separates that initial speculative frenzy from what looks like a more mature, infrastructure-heavy, sustainable future for corporate adoption.
Got it. Okay, let's shift gears again slightly. Part 4, foundational pillars. Things happening beyond just price and corporate treasuries.
Right, the deep structural stuff.
You mentioned 3 major non-price developments that are really strengthening the long-term case, sort of quietly happening beneath all this surface volatility. Let's start with AI. This connection between Bitcoin mining and AI infrastructure, is it just hyped, the latest market narrative, or is there real capital flowing behind it?
The capital flow proves it's absolutely fundamental. This is pillar 1, miners as AI infrastructure. That narrative is getting overwhelming validation from the market itself. Look at Cipher Mining.
Okay.
Their financing deal for expanding their high-performance computing, or HPC capabilities, it was initially set for $800 million. It got upsized to $1.1 billion.
Wow, from $800 million to $1.1 billion. Why the increase?
Purely massive institutional demand they wanted in. And this capital, crucially, is explicitly earmarked for building out data centers, actual AI infrastructure.
Not just more mining rigs.
Exactly. This validates the whole thesis. Miners are uniquely positioned, often with low-cost power, to provide flexible, scalable infrastructure for the AI industry. That's a massive new demand driver, completely separate from Bitcoin price, and it connects to deals we've already seen, like that Google-backed FluidStack partnership.
Okay, so AI is real, pillar number 1. What's pillar 2?
Pillar 2, bridging TradFi and DeFi, the traditional financial world and the decentralized one. And a huge, maybe underreported story here is the Ripple Securitize partnership.
Ripple and Securitize, what does that enable?
Okay, it allows Ripple's regulated stablecoin, RLUSD, to integrate directly with tokenized real-world asset funds, RWA funds, from major TradFi players. We're talking about BlackRock's BUIDL fund.
BlackRock again.
And VinX VBL fund. These are tokenized versions of things like treasury bills.
Mm-hmm.
So this partnership creates seamless, programmable settlement rails between a regulated stablecoin and tokenized traditional assets.
So it's moving beyond just crypto speculation.
Way beyond. This is transforming crypto tech into core financial plumbing for mainstream real-world assets. It's about efficiency, programmability, settlement, foundational stuff.
Okay, that's huge. Pillar 3.
And pillar 3, government acceptance. You really don't get much more mainstream than actual state governments adopting this stuff.
Which state are we talking about?
The state of Ohio. Through the Ohio Board of Deposit, they formally approved accepting cryptocurrency payments, including Bitcoin, for state fees and services.
Paying taxes or fees in Bitcoin in Ohio?
Potentially, yes. The Secretary of State's office is leading the rollout. Now, when a major U.S. state starts integrating crypto payments into its core governmental functions, that sends an undeniable, very practical signal of legitimacy. It's mainstream integration happening right there.
Wow. AI infrastructure, TradFi bridging, state government acceptance. Those are pretty solid pillars.
Very solid. And largely independent of the daily price swings.
Okay, let's move to the final area before we synthesize. Part 5, the ecosystem frontier, layer 2 acceleration.
The L2s, yeah. Where a lot of the innovation is happening.
This is perhaps the most exciting frontier right now because it's really about unlocking Bitcoin's utility, making it a productive asset, not just something you hold.
Exactly. Putting Bitcoin to work.
And the demand for yield on Bitcoin seems astronomical. We're seeing reports, for example, that Merlin Chain is offering up to 21% APY on staked BTC.
21%. That's a headline number.
It really is. And it's fueling a surge in their ecosystem, their native token Merl. And then look at Lombard Protocol, their yield-bearing LBTC token, which is actually on Solana, has attracted over $1.5 billion in liquidity.
$1.5 billion.
Yeah.
Just for yield on Bitcoin, bridged over.
It's massive. It proves people are willing to move billions across chains just to deploy their Bitcoin capital for yield. The demand is clearly there.
That high-utility, high-yield approach is definitely one massive force in the L2 space. Billions are chasing it. But interestingly, you have this parallel movement, almost a counter movement, focused intensely on technical purity, on security inheritance from Bitcoin itself.
Okay, purity versus utility.
Sort of. This is where projects like GO80 Network come into the picture.
GO80 Network, what's their focus?
They're aiming to build what they call a truly verifiable Bitcoin ZK rollup. And critically, they're focused on implementing the BitVM2 framework.
Okay, lots of tech terms there. ZK rollup, BitVM2. For listeners who aren't deep protocol nerds, can you quickly break those down? Why are they important for Bitcoin's integrity?
Sure. So ZK rollup ZK stands for zero knowledge. It's basically a scaling solution. It processes a whole bunch of transactions off the main Bitcoin chain, bundles them up, and then posts a compact cryptographic proof back onto the main chain, proving those transactions happened correctly.
So it increases speed and lowers fees, basically.
Exactly. Dramatically improves scalability, can potentially enhance privacy too.
Mm-hmm.
Now, BitVM2 is even more cutting edge. It's this advanced concept that aims to allow developers to run complex smart contracts like you see on Ethereum, but on Bitcoin, without actually needing to change Bitcoin's core rules.
Wow. Okay, how does it do that?
It's complex, but essentially it uses existing Bitcoin transaction types and scripts in clever ways to enable verification of these off-chain computations. It's about adding functionality while preserving Bitcoin's core security model.
Very ambitious.
Extremely. So GO80 Network is trying to actually implement this BitVM2 framework. And they've also released something called a Bitcoin Native Layer 2 Network benchmark proposal. They want to set clear technical standards for L2s, focusing on things like trust minimization, how little you have to trust the L2 operators, and security inheritance, how much security they actually draw from the main Bitcoin network.
So it's a push for standards and technical rigor.
Exactly. So this whole L2 space, it's fascinating. You've got this competition heating up, models like Merlin chasing billions in immediate liquidity and yield, versus models like JXT focusing intensely on technical purity, long-term trust minimization, staying Bitcoin native.
Both directions suggest a lot of activity, though.
Oh, absolutely. Both indicate a really vibrant developing ecosystem around Bitcoin itself. It's not just static digital gold anymore.
Okay, fantastic overview. Let's try and synthesize all this. Part 6, synthesis and forward outlook. So what does this all mean for you, the listener, trying to navigate this crazy volatility?
Yeah, what's the takeaway?
Well, the core tension we started with, it's not only clear, it seems to be accelerating. You've got the severe, short-term technical storm, the liquidations, the fear, the broken support.
It's scary headlines.
Exactly, and that's crashing headlong into this undeniable, also accelerating long-term fundamental trend, institutionalization, utility, infrastructure building.
Two completely different narratives playing out simultaneously.
Right, so to navigate the next few days, maybe weeks, what are the critical catalysts you need to be watching? I think there are 3 key things.
Okay.
First, obviously, daily U.S. spot ETF flows. We really need to see a quick return to positive net inflows there. That would help stabilize sentiment, maybe establish a price floor.
Crucial for near-term sentiment, yeah.
Yeah. Second, defensive support. Keep a close eye on the market's ability to hold that session low we talked about, around $108,700. A decisive break below that really does open the door to deeper tests, potentially towards that $100 case psychological level.
That's the key technical level right now.
And third, look beyond the price chart itself. Watch Bitcoin Layer 2 TVL growth, total value locked, continued growth in TVL for protocols like Merlin, Lombard, others. That signals the health and resilience of the utility narrative.
The adoption story.
Exactly, which is ultimately the strongest long-term counterweight to all this short-term price turbulence.
I think that's spot on. The immediate noise, the volatility we saw, it's largely tactical. It's driven by derivatives, by liquidations, a short-term market event.
Right.
But the underlying structural changes we discussed, BlackRock filing for a new yield product specifically for conservative investors, that $1.1 billion pouring into minor AI infrastructure, Ohio accepting crypto payments, billions flowing into L2 liquidity.
Foundational shifts.
These are strategic foundational indicators. They don't just reverse overnight based on a bad day in the market.
Okay, so final thoughts. What's the provocative closing idea for our listeners to chew on?
Well, consider this. We know the sophisticated long-term holders, the LTHs, have executed this measured distribution, taking 3.4 million BTC worth of profit off the table. They're showing signs of exhaustion at these levels.
A huge amount of supply hitting the market.
Huge supply. And at the same time, new institutional products are arriving, specifically designed to attract conservative, traditional, income-seeking capital that wasn't here before.
Okay.
So the provocative question we leave you with is this. Who's going to be the primary driver of the next wave of sustained demand?
Yeah.
Where does the buying pressure come from now?
Right. With LTHs selling.
Exactly. Will it be the risk-off traditional investor finally dipping their toes in via something like BlackRock's new yield ETF, seeking predictable income? Or will it be the more risk-on, tech-savvy utility seeker diving into the next big layer 2 play, chasing yield and new applications?
TradFi yield versus DeFi utility.
Basically, the answer to that question, where the next marginal buyer comes from, will likely define the direction and the character of the market for the rest of this cycle.